Disclaimer, September 15th, 2008, 1:45 a.m. The largest bankruptcy in American history was about to be filed. $613 billion in debts, $639 billion in assets, and 26,000 employees who had no idea their lives were about to change forever. When Lehman Brothers filed for Chapter 11 bankruptcy protection that Monday morning, the Dow Jones dropped 504 points in a single day, the biggest one-day point drop since 9/11. But here's what most people don't know. This wasn't just one company failing. This was the match that lit the fuse on a bomb that had been building for years. A bomb that would wipe out $10 trillion in stock market value worldwide. A bomb that would push unemployment to 10% and leave millions of families homeless. I'm going to show you exactly how it happened. And trust me, it's way crazier than you think. But first, if you're interested in deep dives into financial history and economic disasters, hit that subscribe button. We're just getting started. Let's go back. Way back. Lehman Brothers was founded in 1850 by 3 German immigrant brothers in Montgomery, Alabama. Yeah, you heard that right. 1850. This company was 158 years old when it died. They started as a dry goods store, then moved into cotton trading. By the early 1900s, they'd shifted to New York and transformed themselves into an investment bank. And here's the thing, they survived everything. The Great Depression, Black Monday in 1987, the dot-com crash, even 9/11 when their World Trade Center offices were destroyed. By 2008, they were the 4th largest investment bank in the United States, right behind Goldman Sachs, Morgan Stanley, and Merrill Lynch. They had about 25,000 employees worldwide and reported $639 billion in assets. In 2007 alone, they posted profits of $4, $2 billion. So what went wrong? To understand Lehman's collapse, you need to understand what was happening in America in the early 2000s. And it all starts with mortgages. After 9/11 and the dot-com crash, the Federal Reserve slashed interest rates to historic lows. I'm talking the federal funds rate dropping from over 6% to just 1% by 2003. Cheap money was everywhere. Banks started lending to everyone. And I mean everyone. You've probably heard the term subprime mortgages. These were loans given to people with poor credit, sometimes with no down payment required. From 2001 to 2007, U.S. mortgage debt nearly doubled. The amount of mortgage debt per household jumped 63%. From $91,500 to $149,500. And here's the kicker. Wages stayed flat. Housing prices went absolutely insane. Between 1997 and 2006, American house prices rose 124%. In some coastal areas, homes were selling for 5 times what they were worth just a few years earlier. People thought it would never stop. But Lehman wasn't just lending money for mortgages. They were doing something way more complicated and way more dangerous. All right, stay with me here because this is where it gets wild. Lehman and other investment banks weren't just giving out mortgages. They were bundling thousands of these mortgages together into things called mortgage-backed securities, or MBS. Think of it like this. Take 1,000 mortgages, throw them in a blender, and sell shares of that blend to investors. Those investors get paid when homeowners make their mortgage payments. But they didn't stop there. They took these mortgage-backed securities and sliced them into different levels of risk called tranches. The safest ones got AAA ratings from agencies like Moody's and Standard & Poor's. The riskier ones, they were supposed to pay higher returns. Then, and this is the insane part, they took the riskiest tranches from multiple mortgage-backed securities and bundled those together into new products called collateralized debt obligations, or CDOs. It was like taking all the worst parts of thousands of loans, repackaging them, and somehow getting rating agencies to call them safe. By 2004, the SEC made a decision that would prove catastrophic. They relaxed leverage rules for the 5 biggest investment banks, including Lehman Brothers. These banks could now borrow 30 times or more than their actual capital. Lehman went wild. They ramped up leverage from about 24:1 in 2003 to over 30.1 by 2007. What does that mean in plain English? For every dollar Lehman actually owned, they were borrowing and investing $30. You don't need to be a finance genius to see the problem. If the value of their investments dropped by just 3%, they'd wipe out all their capital. And guess what started happening in 2006? Housing prices peaked in 2006 and started falling. At first, it was slow, a few foreclosures here and there. Subprime lenders started having trouble. In April 2007, New Century Financial, one of the largest subprime lenders, filed for bankruptcy. That same summer, 2 Bear Stearns hedge funds that were heavily invested in subprime mortgages imploded, losing nearly all their investor capital. But Lehman? They were actually increasing their exposure to mortgages. Between 2006 and 2007, while smart money was running away from real estate, Lehman doubled down. They were underwriting mortgages, creating mortgage-backed securities, investing in commercial real estate, all of it. CEO Richard Fuld, nicknamed the Gorilla for his intimidating presence, had been with Lehman for nearly 40 years. He'd steered the company through the Asian financial crisis in 1997. He wasn't about to abandon the strategy that had given them 14 straight years of profits. But the data was screaming danger. By 2007, mortgage default rates were climbing. People who'd taken out adjustable rate mortgages were getting hit with higher payments they couldn't afford. Foreclosure filings jumped 79% in 2007 compared to 2006. Nearly 3 million properties. And all those safe, old or AA-rated mortgage securities, they started getting downgraded to junk. And there was this index called the ABX that tracked mortgage-backed securities. In early 2007, it started dropping like a stone. That was the canary in the coal mine. On March 13th, 2008, Bear Stearns, Lehman's closest competitor, was on the verge of total collapse. Bear had $18 billion in cash on March 10th. By March 13th, they were down to $2 billion. What happened? An old-fashioned bank run, but for investment banks. Their clients and trading partners pulled their money out, and other banks refused to lend to them. They relied on something called repo agreements, short-term loans that banks give each other overnight. When those dried up, Bear Stearns was dead. That weekend, March 14th, 16th, the Federal Reserve and Treasury Secretary Henry Paulson scrambled to save the financial system. J.P. Morgan Chase agreed to buy Bear Stearns for $2 per share. Let me put that in perspective. Bear's stock had been trading at $170 per share just 14 months earlier. $100. It closed at $93 per share in February 2008. The Fed had to provide a $29 billion loan to J.P. Morgan to make the deal work, taking on billions in toxic mortgage assets. But here's what matters. Wall Street now knew that investment banks could die. Fast. And everyone started asking, who's next? Rumors started swirling about Lehman in the spring. Their stock, which had hit a high of $86 per share in February 2007, was in free fall. On June 9th, 2008, Lehman reported its first loss in 14 years, $2, $8 billion for the quarter. Both the president and CEO stepped down, but Richard Fuld stayed. He tried to raise capital, bringing in $6 billion in equity in June. He insisted Lehman was strong, that they had adequate capital and liquidity. Behind the scenes, different story. Lehman held massive positions in commercial real estate and mortgage-backed securities, and the value of those assets was plummeting. By some estimates, they were sitting on $4 billion in mortgage securities that were basically worthless. Then came September 9th, 2008. Lehman pre-announced their third quarter results. The numbers were brutal, a $9 billion loss. They were writing down $7, $8 billion on their mortgage holdings. Their stock dropped 45% in one day. Rating agencies threatened to downgrade them. Moody's made it clear if they couldn't find a buyer or raise more capital, they were toast. That weekend, September 12th, 14, was the last chance. Treasury Secretary Paulson and Fed Chairman Ben Bernanke called an emergency meeting at the Federal Reserve Bank of New York. Every major bank CEO was there. They were trying to arrange a buyout of Lehman, anything to prevent a bankruptcy. There were two potential buyers, Bank of America and Barclays from London, but Bank of America backed out. They decided to buy Merrill Lynch instead, another investment bank that was also in trouble. Barclays wanted to buy Lehman, but British regulators said no. They wouldn't allow it without guarantees, and the U.S. government wasn't willing to provide them. Here's where it gets controversial. 6 months earlier, the Fed had bailed out Bear Stearns. Just a week before, on September 7th, they'd taken over Fannie Mae and Freddie Mac, the government-sponsored mortgage giants, in a conservatorship. But Paulson drew a line with Lehman. No government bailout, no backstop. They'd let the market decide. Years later, Fuld would testify before Congress, still bitter. Until the day they put me in the ground, I will wonder why Lehman was allowed to fail while others were saved. On Sunday night, September 14th, the deal fell apart completely. Early Monday morning, September 15th, 2008, around 1:45 a.m., Lehman Brothers filed for Chapter 11 bankruptcy protection, the largest bankruptcy in U.S. history, $639 billion in assets, $613 billion in debts. Monday, September 15th, the day Wall Street broke. When markets opened Monday morning, it was chaos. The Dow Jones Industrial Average dropped 504 points, a 4% decline. At the time, the largest single-day point drop since 9/11. But the point drop was just the visible symptom. The real damage was happening in the shadows of the financial system. Money market funds, which millions of Americans thought were as safe as bank accounts, started breaking. The Reserve Primary Fund, which had invested in Lehman's commercial paper, broke the buck, meaning its value fell below $1 per share. Investors panicked and pulled $196 billion out of money market funds in a single week. The commercial paper market, where businesses get short-term loans to meet payroll and buy supplies, froze. Banks stopped lending to each other because nobody knew who was holding toxic assets. Credit default swaps, those insurance contracts on debt, went haywire. Lehman had been a counterparty on 906,000 derivative contracts with a notional value of $35 trillion. That's trillion with a T. Global markets crashed. The London Stock Exchange fell. Hong Kong tanked. Germany's stock market dropped. It was spreading like a virus. But wait, it gets worse. On Tuesday, September 16th, one day after Lehman failed, the Federal Reserve had to step in with an $85 billion emergency loan to insurance giant AIG. AIG had written $500 billion in credit default swaps, basically insurance on mortgage-backed securities. When Lehman collapsed and credit markets froze, AIG suddenly owed $32 billion in collateral it didn't have. The Fed took a 9% equity stake in AIG to prevent its bankruptcy. If AIG had gone down, it would have triggered a complete meltdown of the global financial system. Think about that timing. Paulson said no to bailing out Lehman on Sunday. Then on Tuesday, he had to bail out AIG with taxpayer money anyway. That same week, Washington Mutual, the largest savings and loan in America, collapsed. Merrill Lynch got emergency bought by Bank of America. Goldman Sachs and Morgan Stanley, the last two independent investment banks, converted to bank holding companies just to survive. The entire model of investment banking in America died in 10 days. Let's talk about real people for a second. 26,000 Lehman employees lost their jobs almost overnight. People who'd worked there for decades, who had their retirement savings in company stock that was now worthless. Richard Fuld, remember him? He walked away with about $480 million in compensation from 2000 to 2008. When he testified before Congress in October 2008, Representative Henry Waxman pointed out that Fuld owned a mansion in Connecticut, an oceanfront estate in Florida, a ski chalet in Idaho, and a Manhattan apartment. If you haven't discovered your role, one congressman told him, you're the villain today. But Fuld defended himself. He said he'd actually only made about $350 million because the Lehman stock he owned was now worthless. That's still a lot of money, he admitted. Meanwhile, millions of regular Americans were getting destroyed. By March 2009, the Dow Jones had fallen 53%, from 14th to 164 in October 2007 to 6,594. Unemployment hit 10%. About 8 million jobs were lost. Housing prices dropped an average of 40% nationwide. People lost their homes. Their retirement accounts crashed. College funds evaporated. The Great Recession that followed was the worst economic disaster since the Great Depression. So what actually caused this? Look, there's not just one villain here. It was a perfect storm of terrible decisions. First, subprime lending run amok. Lenders were giving mortgages to people who had no chance of paying them back. Some mortgages required zero down payment. Others were ninja loans. No income, no job, no assets. Second, rating agencies completely failed. Moody's, Standard & Poor's, and Fitch were slapping A ratings on securities filled with junk mortgages. Why? Because the banks creating these securities were paying the rating agencies. Massive conflict of interest. Third, crazy leverage. When the SEC relaxed leverage rules in 2004, investment banks borrowed like drunken sailors. Lehman at 30-1. Bear Stearns at similar levels. One bad quarter could, and did, wipe them out. Fourth, derivatives and financial innovation. These collateralized debt obligations and credit default swaps were so complex that even the people selling them didn't fully understand the risk. Warren Buffett called derivatives financial weapons of mass destruction back in 2002. He was right. Fifth, regulators asleep at the wheel. The SEC, the Fed, Treasury, they all saw the housing bubble inflating but did nothing to stop it. And sixth, greed. Plain and simple greed. Bankers were getting massive bonuses for short-term profits while loading up on long-term risks that taxpayers would eventually pay for. On September 19, 2008, 4 days after Lehman collapsed, Paulson and Bernanke went to Congress with an emergency request. They needed $700 billion for the Troubled Asset Relief Program, or TARP. The banking system was hours away from total collapse. ATMs were about to stop working. Credit cards would be declined. Businesses couldn't make payroll. Congress initially rejected it. The Dow dropped 777 points in one day, September 29th, too late. The largest single-day drop in history at that time. They passed it on the second try on October 3rd. Banks got bailouts. AIG got $182 billion total. The auto industry got bailouts. The Fed started buying treasury bonds and mortgage-backed securities, what they called quantitative easing, adding more than $4 trillion to the financial system over the next few years. The government ended up recovering most of the TARP money with interest. But that doesn't account for the human cost, the lost wealth, the destroyed lives. In 2010, Congress passed the Dodd-Frank Wall Street Reform and Consumer Protection Act. It created new rules, higher capital requirements for banks, restrictions on proprietary trading, the Volcker Rule, a new Consumer Financial Protection Bureau, requirements that derivatives be traded on exchanges instead of private deals. The goal was to prevent another 2008, to make sure taxpayers wouldn't have to bail out banks again. But here's the thing, and I want you to really think about this. Many of those regulations have been weakened or rolled back. Banks lobbied hard. They argued the rules were too restrictive, that they were hurting economic growth. And the banks are bigger now than they were in 2008. The too big to fail problem hasn't been solved. If anything, it's worse. 15 years later, what have we learned? On paper, banks are better capitalized. Stress tests are required. There's more oversight. But the fundamental dynamics haven't changed. We still have massive banks with opaque balance sheets. We still have complex derivatives. We still have a financial system where one failure can threaten everything. Robert McDonald, a former Lehman vice president, said something that stuck with me. Every fraction of every inch of those financial graphs represents hope or fear, confidence or dread, triumph or ruin, celebration or sorrow. Those weren't just numbers on a screen. They were people's lives. When I looked into the stories of regular Lehman employees, not the executives, but the analysts, the back office workers, the people just trying to do their jobs, it's heartbreaking. Many lost their jobs and their savings on the same day. Their company stock, their 401ks, their severance, all gone. One administrative assistant had worked there for 22 years. She was 3 years from retirement. Everything vanished. So here's the question nobody wants to ask. Could it happen again? The honest answer? Absolutely. Different trigger, same dynamics. Maybe it's commercial real estate next time. Maybe it's corporate debt. Maybe it's something in the shadow banking system we don't even see coming. The warning signs from 2008 are flashing again in different ways. Corporate debt is at record highs. Private equity firms are loaded with leverage. Commercial real estate is under pressure as offices sit empty. And we've got new risks, cryptocurrency, AI-driven trading, geopolitical tensions. Some economists think we've learned our lesson. Others say we're just building up to the next crisis. Economist Hyman Minsky had this theory called the financial instability hypothesis. The basic idea, stability breeds instability. When things are calm for a long time, people take bigger risks. They forget what can go wrong. And eventually, boom, it all comes crashing down. But maybe the biggest impact of Lehman's collapse wasn't even economic. It was political and social. According to The Economist, the financial crisis turbocharged today's populist surge, raising questions about income inequality, job insecurity, and globalization. People watched bankers get bailed out while they lost their homes. They saw executives walk away with millions, while millions of regular people suffered. That anger didn't go away. It fueled political movements on both the left and the right. It undermined trust in institutions. It changed how people view capitalism, government, and fairness. When you hear about wealth inequality, when you hear about the 1%, when you hear about the system is rigged, a lot of that traces back to 2008. Lehman Brothers, 158 years old, fourth largest investment bank in America, $639 billion in assets, gone in a weekend. The bankruptcy filing that triggered the worst financial crisis since the Great Depression, that wiped out $10 trillion in wealth, that cost 8 million jobs, that pushed the global economy to the brink of total collapse. And it all could have been prevented if regulators had acted sooner, if banks had been less greedy, if we'd learned from past crises instead of assuming this time is different. September 15th, 2008 should be remembered not just as the day Lehman died, but as the day we learned, or should have learned, that when it comes to financial risk, there's no such thing as too big to fail. There's only too big to exist. So here's what I want from you. Leave a comment. What do you think we've actually learned from 2008? Do you think another crisis is coming? What worries you most about the current financial system? I read every comment, and honestly, some of the best insights come from you guys. If you made it this far, thank you. This was a deep one. Hit that subscribe button if you want more financial history deep dives like this. We've got more stories about how the economy really works, the crises everyone forgot, and the patterns that keep repeating. Next video, I'm looking at the collapse of SVB, Silicon Valley Bank, in 2023 and asking, did we learn anything from 2008? Spoiler alert, not as much as we should have. Thanks for watching. I'll see you in the next one.